policy for the especially in we spoke, we were talking about liquidity risk and equity gets affected, and liquidity risk and credit risk. We said a few things about capital adequacy. Right. And I have papers to those people who didn't come to the tutorial. Okay, so before we look at the actual off-balance sheet, we'll just talk about the different off-balance sheet activities. We've mentioned them, but we haven't gone into them in any sort of detail. So basically, what I'm going to be doing here, it's not a lot of slides, is to really just highlight what those activities are, a couple of definitions, and then the risk that they pose. All right, so your off-balance sheet activities, because they are not the principal functions of the bank and other financial institutions, they are less obvious than the quote-unquote on-balance sheet activities. So on-balance sheet activities, what are those? Identify those.
Is it on?
They on.
Loan commitments.
Loans.
Demand deposit.
Deposits. Investments. Anything else? Remittances. Okay, what else? If an insurance company, what? An insurance company, what? Property, plant, equipment, what else? An insurance company. You all need to go back to your chapter, the early chapters of the text. Alright? Because what I find, you tend to, somewhere here, make noise. Alright. I think there's something that I think I know. Stay on the class. Right, so your on-balance sheet for the other, remember we're not just talking about banks, you know. We use banks for loans and so on, but there are others, so please don't forget. Alright? I was pleased that a couple of people recognized that in the midterm, but not everybody, not most people. Anyways, so those are your on-balance sheet activities, and those are your on-balance sheet activities. The off-balance sheet activities are those activities that generally they are going to provide more income for the commercial bank. And it's not so much that they are quote unquote off the balance sheet, but they are not the principal functions of the commercial bank and the other financial institution. So they are not as obvious as the on-balance sheet activities. So when it comes to accounting, your off-balance sheet activities or the items, they usually appear below the bottom line. And when we say below the bottom line, we mean as footnotes, right? And so when they're actually in the balance sheet, but they're lumped into something called other assets, so, right? But they're actually on the balance sheet. You will see them in the notes to the financial statements. All right, that's where you would find those. So they are considered to be contingent assets and liabilities that affect the future, right? So something like a case, a legal, if a financial institution has a legal case, that is a liability, that's a contingent liability, it's a potential liability, but you may not know how much it is, and what the liability actual amount is going to be. You have to put that in your footnotes as a contingent liability. All right? The loan commitment, it's off balance sheet, it's a contingent liability, unless of course it becomes a loan. So the loan commitment is just a contract. All right? Unless it becomes so. And then your options and your futures. All right? Those are actually investments. All right? But depending on where they are in their cycle, in their life cycle, they're going to just appear in other investments, and then you will see them later on in the notes. All right? However, these off-balance sheet activities, they have an impact on the future profitability and performance of the financial institution. All right? Now, so for example, if you look at foreign exchange transaction, purchase and sale of foreign exchange, right? The banks will have an account, a foreign exchange account with another bank somewhere, where they use that to buy and sell, right? Now, they're going to try to keep as minimal a balance as possible in those, all right? So there'll be assets, all right? And they will be recorded in cash, but they are foreign assets, okay? And so you'll see those in the notes. The off-balance sheet activities, they are banks engage in them either for hedging purposes to protect them, their assets, but mainly for fees. All right, so it's called non-interest income, and in the income statement you will see non-interest income. All right, so even with insurance companies, even with investment companies, you're gonna find that they have investment portfolios, all right? They earn interest on them. They're going to be on the balance sheet, but that's not their principal activity, okay? They often, very, very often involve risk, because when we talk about foreign exchange and we're talking about hedging, futures, options, they will involve risk, okay? And so a lot of the 2008 to 2009, in that crisis, many banks lost a significant amount of money in that crisis because they had portfolios. The other thing, not just portfolios, but they are allowed to invest in all sorts of financially engineered instruments, right? So they were exposed to that, and so the losses that they would have incurred from, especially mortgage-backed securities, that affected many banks. And in the US, they had to be bailed out. In Europe, they had to be bailed out. And so you had the Basel III community effect, all right? And you can go to the text to see the losses that banks in particular would have incurred from the off-balance sheet activity. Other off-balance sheet activities, your loan commitments, that is a contract to say that they are going to give a loan. They pretty much guarantee that they can give this loan. Not all the time they need to give it, and that's why it's called a contingent liability, because it's a contract, right? And it's a contract, but they don't have to act on it unless unless the customer requires it. Then you have the letters of credit. Again, the letters of credit or balance sheet activity, they make a lot of money from it, because very often with letters of credit, they ask the customer to place a deposit. All right, so they can use the money from that deposit to give a loan. All right, and it's a guarantee. It's a guarantee. The letter of credit is a guarantee, right? If the customer defaults, does not pay the trader, whoever they're trading with, then the importer, they don't pay, then the bank has to pay. So it's a contingent liability. It poses a risk for them. It poses a credit risk for them. Then you have the derivative contracts. We spoke about those. The options, the futures, the forwards. They use those to protect themselves from foreign exchange losses. Some institutions use those as a way of making money as well. So they don't just use them for hedging and protection, but they also use them to make money. All right? Something called when issued trading, that's trading in securities prior to their actual issue. That is going to be a contingent liability. You're not going to see it on the balance sheet. They have entered into agreement to purchase securities when they're issued. All right? So there's a potential for that. Then you have something called loan sold. A financial institution will try to take some of the risk, the credit risk from its balance sheet, all right? And what they will do is they will sell the loans. They'll sell their loans to another bank, or they sell their loans to a home mortgage bank, all right? We have one of those in the region, it's the Caribbean Home Mortgage Bank. So they sell the loans, they make money on them. Often when they sell the loans though, they come off of their balance sheet, right? So they'll be taken off of the asset side. But they still collect the payments and then remit the payments to wherever they sold the loan to. All right? So loan sold. So they use that to take some of the credit risk away from them. All right? So that's one way they can reduce their risk. Now, the risks that are associated with off-balance sheet activities, I know those in the back can't see, but it's in the portal. You have settlement risk. Settlement risk has to do with when they do their foreign exchange transactions, like their wires and so on. There's always the risk that that wire doesn't reach where it's going. Okay? Or if they purchase a security, there's always the risk that they don't get the security. So that's settlement risk. And that's the risk that a transaction is not completed, and so you lose money on that. All right? Something called affiliate risk. Risk imposed on one holding company affiliate due to the potential failure of the other holding company affiliates. Okay? What's a holding company? Everybody knows what that is? We don't. So holding company is it's like a parent company that holds the subsidiaries. So Bank of St. Lucia Holdings, that's the one that comes to mind. Bank of St. Lucia Holdings has Bank of St. Lucia, it has Bank of St. Lucia Investment Bank, and it has some other entity. It's a holding company. So that company is like the parent, that and the others are, they're not subsidiaries per se, but they're fully owned by the holding company. All right? So Bank of St. Lucia Investment Limited, which manages portfolios, they're brokers, they hold portfolios. If there's a failure of that, then the bank itself, the commercial bank itself, will pay the Now, another example, ABI Holdings. You familiar with that one? ABI Holdings had ABI Bank, ABI Insurance, ABI Investments, Antigua Overseas Bank Limited, Jolly Beach Vacations. They had a company in Turks and Caicos. I think they had a company in Miami. ABI Bank and one of the other affiliates got into trouble. So Antigua Overseas Bank was liquidated, ABI Bank was liquidated. The investment company is still in there. Jolly Beach Vacations was liquidated. The TCI one was liquidated a long time ago. So the risk of potential failure of one affects the other. So ABI Insurance is still holding strong. I heard the other day that they wanted to sell it, but they're still holding strong. All right. Then of course there's credit risk. All right, remember I mentioned the credit risk with the loan commitment and with letters of credit, you get credit risk from that. And there's interest rate risk. If you're holding options and futures on bonds and stocks, and your stock and bond portfolio, you're going to be faced with interest rate risk. Then there's something called basis risk. Basis risk is the difference between what you charge on your loans and what you have to pay when you borrow. All right, so basis risk occurs where there's a spread between those two. All right, it could be a negative spread, it could be a positive spread, but that gives you basis risk. And basis comes from the term basis points. 1% is 100 basis points, and so small incremental percentage are, like the spreads, are measured in basis points. Then takedown risk, that comes from the loan commitments. That's the uncertainty involved with the timing of the takedown of a loan commitment. Because with the loan commitment, you make the commitment that you can give this loan to this company if necessary. How long do you hold that for? So the period in which you're holding that loan commitment poses some risk. All right? So that's the takedown risk. Then you have default risk on over-the-counter contracts that increases with time to maturity of the contract and the fluctuation of the underlying prices, interest rates, or exchange rates. So with your over-the-counter forward contracts, for example, a forward contract being you enter into a contract to purchase currency at a particular rate at a particular point in time. Those are over-the-counter contracts, and so you run the risk of a default on those over-the-counter contracts, so that's default risk or credit risk, right? Of course, remember we spoke to credit risk, that occurs because of the potential for the counterparty to default on its payment obligations under a derivative contract, all right, mostly with the forwards. A situation that would require the financial institution to replace the contract at the current market price and rate, potentially at a loss. Other derivatives, you also have swaps, interest rate swaps, all right? And so you run the risk of credit risk there, because with an interest rate swap, the bank is acting, international banks that is, usually our local banks don't get involved in that. An international bank offers a service where they become the main player in it, where if the government, for instance, wants to issue a bond, all right, and it has another counterparty somewhere else, a multinational company that is trying to raise funds. The government, let's say, is issuing the bond at a fixed rate. The multinational is getting a loan outside, but it's getting the loan at a floating rate, because when you're doing loans internationally, it's usually a floating rate. And so the government may not mind a floating rate instrument, and so the bank acts as a middleman and collects the interest from both parties and swaps that interest. So the government will get its floating, the multinational will get its fixed, but of course, the bank in the middle is going to make some money. So if one of those counterparties defaults, then that's another way that the bank could end up facing credit risk. All right? Financial institutions that hold large amounts of credit derivatives hold them in what is known as special purpose vehicles or special investment vehicles. All right? Some of them, they're also known as shadow banks. All right, so you could have a financial institution that trades in derivatives, credit derivatives. We know what credit derivatives are. So credit derivatives are like, so you take ready cash, what's ready cash? They issue these payday loans. They issue loans to people to purchase furniture and so on. Courts does this thriving business in ready cash, and courts can actually bundle these receivables from their ready cash loans and sell it as a security. That becomes a credit derivative. All right? Mortgage-backed securities are credit derivatives. So what the financial institutions tend to do is to create a company or a subsidiary that holds those instruments and they trade in them, right? So they are called a special purpose vehicle. They may have 2 people working in that area, all right? So that creates risk as well. So an SPV purchases the assets, newly originated loans from the originating bank for cash generated from the sale of asset-backed securities. Asset-backed securities means that you have an asset, you're issuing a security backed by an asset, like mortgages. All right? And they sell these securities, you can buy from them, all right? And they have to pay the interest on the securities. The SPV sells the newly created asset-backed securities, also called credit derivatives, to investors such as insurance companies and pension funds, earning a fee for their services. An SIV, or so the SPV is a special purpose, the SIV is a special investment vehicle. It's an operating company that invests in assets that are designed to give higher returns than the SIV's cost of funds. Now, I'm sure somewhere along the line you'd have heard of the Clico debacle. Clico invested in a lot of asset-backed securities, all right? And so that was part of why Clico crashed right along with that is why Clico crashed right along with the rest of the mortgage market in the US, right? And here in Antigua, we would have suffered because many ordinary Antiguans, along with companies, would have invested in, so British American was owned by Clico. British American was selling these like fixed deposits and annuities. And so persons would have invested their their monies in these vehicles, in these assets because they were given higher returns. Right, but British American was owned by Clico, it was an insurance company, but it got involved in selling annuities and also fixed deposits, which gave higher returns, and so people were attracted by that. I mean, even Social Security and some other insurance companies would have invested with British American. Additionally, the car park on Independence Avenue, that car park was it was what you call a boot arrangement, which is a build, own, operate, and transfer. So the company that was building that was funded by Clico's bank. And so when Clico went belly up, the company had no more money to continue the car park. And so back in around 2017 or so, the government had to actually purchase back the car park from the company that was managing it. Yeah, so it wasn't like, yeah, so let's leave it there. All right, so my point that Antigua would have suffered from that, these financial institutions getting involved in these special purpose vehicle type activities. All right. When issue trading, investment banks mostly tend to get involved in these because with investment banks, they're often underwriters, right? And so they are able to, so companies, corporations that issue loans, they are allowed, especially in the US, I don't think it's allowed here, but I know particularly in the US, they are allowed to create instruments, and they're referred to as when issue. They create them, so they submit the prospectus, they pay for the issue, all right? So everything is cleared, everything is above board, but it's not yet issued. And so investment companies in particular, investment banks in particular, would purchase these when issued securities, mostly bonds, like I said, and so they enter into commitments to buy or sell them. So they have them in their inventory. So when the issuer is ready to issue now, then they will go ahead and purchase or sell them. All right? So that's when issue trading. Again, it's not a tangible asset. And it's not on your balance sheet. It's a contingent asset because you haven't actually purchased it. You've just signed a commitment to purchase. All right? Those can expose a financial institution to future or contingent interest rate risk. Commercial banks also hold these as well. Like I said, in the more developed world, not so much for us here. And so they include them as part of their forward contract holdings. Remember we said that they'll enter into forward contracts to hedge their foreign exchange transactions. Now, because so many financial institutions were using derivatives, regulators have now begun to pay attention to it. And so, and when I say now, I mean 20 years ago. And so they are now putting in place, or they have put in place, regulations to deal with it. So in Basel II, they had the 3 pillars where you look at different kinds of risk, all right? And so the regulators have put in place guidelines for dealing with these instruments that increase the risk. And so financial institutions, particularly commercial banks, they have to set aside more capital to compensate for the risk that they face with these. All right, so there's a lot more regulation now. In 2009, the U.S. Financial regulatory system was revamped, and so the previously unregulated over-the-counter derivative securities became regulated back in 2009. So just imagine, those that wasn't regulated, you could just go and purchase and sell stuff without regulation. All right, so that's the off-balance sheet activities, the risk they pose. Now, because on top of the credit risk, all right, that could put a financial institution under the liquidity risk that if they're not able to meet the liquidity requirements, that could put them under, they can become insolvent, all right? And now these activities, which have increased tremendously, billions of dollars are invested off balance sheet by financial institutions, particularly commercial banks. Because of that, the regulation is requiring that you hold more and more capital. All right? So capital adequacy relates to a financial institution being asked to ensure that it has enough capital to cover potential losses from the risk that the institutions are exposed to. And when we talk about capital adequacy, all right, we are not just looking at, your profits and your cash flows and your profits. No, we can't just look at that. With capital adequacy, you have to focus on, you now have to look at the bottom line, all right? So you have to look at, yes, this is your income, your expenditure, this is your net income. But guess what? Nowadays, because on the international financial reporting standards, companies are forced to what we refer to as market their securities, all right? Or in market their securities, they're also using, sorry, name escapes me at the moment, I'll get it. You're using the accrual method. How many accounting majors? Higher. No, I got shy. So you're using the accrual method for your financial reporting, right? Using accrual method means that you're accruing your expenses as they happen, but you're also accruing your income. And so if you have equity securities traded on an exchange, the value of those securities change every day, right? So you have to market, meaning the value of your securities, whatever it is in the market today. So when you look at your bottom line, you may look like you're making money, all right? But not really. Because do you have that physical cash? The other thing is, on your balance sheet, you have receivables, all right? Your receivables make you look like your balance sheet looks good, right? Okay, and so you may look, your bottom line again will look good because you are considering, you're accruing And so your receivables technically become income, right? And so your bottom line looks good. But in fact, it's not real income. So the regulators are saying that financial institutions need to, financial institutions need to maintain a certain level of capital financial institution needs to keep a certain level of capital to buffer one second there. Find this back. They have to keep their capital to buffer to protect against potential losses, right? All right. So you have to maintain sufficient capital to cover any potential losses. Hence, the regulators, particularly the central banks, using the Basel Accord, they have set capital adequacy requirements, right? Requirements. In the insurance industry as well, the insurance regulators, credit unions, so our FSRC, those regulators, the SEC in the US, the FAB in the UK, and so on, they have set capital adequacy requirements for the institutions that they regulate. So for the commercial banks, you want to protect against uninsured deposits, all right? You want to protect against the credit risk. You want to protect against operational risk. You want to protect against technology risk. So you want to protect against all of these risks. Now, because financial institutions are in the market, they have market risk as well, all right? And so they need to protect against that. And there are guidelines as to how much capital you need, okay? And not just how much capital you need to keep, but how you calculate the amount of risk you need to cover. All right, so there are guidelines for that. In the insurance industry, they're required to have a certain amount of capital. They're required to have something called an insurance fund. All right, the insurance fund has short-term, medium-term, long-term securities. All right, and the regulators will also recommend a contingency fund, but you must have a certain amount of capital to buffer. And so the capital adequacy regulation is there to protect not just the financial institution, but it's to protect customers as well. because we have monies invested in these companies. All right, so as a result of the losses incurred by financial institutions, the regulators made the requirements tighter, all right? And so when we talk about capital, what form you think the capital comes in? Is it all cash they have put aside? Okay, so it doesn't have to be all cash, or how else it is? Securities, yes, okay. So now those securities are going to have to be risk-free securities, yes? All right, and your capital adequacy is going to be 8% of what? The capital adequacy requirements is usually a percentage of something. Huh? Could be percent of deposit, percent of your assets. All right? And for banks in particular, it's your risk-weighted assets. Okay? So now it means that you need to go and weight you need to go and assess the risk that everything poses, and then you determine. So you have something called tier 1 capital, you have tier 2 capital, you have tier 3 capital. What are those? All right, so tier 1 capital is going to be it's considered senior common stock. All right, then you go tier 1, tier 2. I want us to have a look at, I think we did this before early on, looking at the Basel website for the capital adequacy regulations. Okay, so the capital is really important because it's going to protect the institution from the different risks. All right. So let us take a look at we're gonna go to BIS. Somehow I shut down all of my, I somehow shut down my browser. It's bis.org. We gotta go to Basel Committee on Bank Supervision. And I wanna look at Basel.
Are you supposed to put it up on the one you like? Yeah. I thought you were gonna show it on the screen.
I could. I will show it on the screen, but to keep it in the back and I don't be able to see. All right. So Basel 3. It's the light. It's the light why I'm not able to see, but my computer is dying. Just give me a moment. So your Basel Accord, we started out with Basel 1, all right, in the early 90s. should have been implemented by 1999, but there was still a struggle anyway. And it's, Basel really provides, the Basel Accord, the standards by which, the standards and guidelines by which commercial banks are monitored. And so you had Basel I, which really looked at capital adequacy, all right? How much capital you should hold to cover your deposits, to cover your loans, all right? But it wasn't very specific in how you do the calculations. So then you had Basel II, all right, where they instituted pillars. So they looked at risk, they looked at your the credit, they looked at operational risk, they looked at am I relying on my memory? Anyway, so they used 3 pillars. So they looked at monitoring, what central banks should be looking at when they are monitoring. All right? So they used the 3 pillars. Then you had Basel III. And so those were in response to the financial crisis of 2007, 2009. And so basically what they were doing here is to strengthen the regulation and the supervision, and as well as risk management of banks, right? So there are minimum requirements, the Basel Accord, Basel I, II, III, there are minimum requirements, right? It doesn't mean that the bank should not be using higher requirements. So like at the ECCB, they use these minimum requirements, but banks themselves, they self-regulate to some degree, and so they will hold more. So they're not just holding, in their guidelines, they are telling you how much liquidity you need to hold given X, all right? They're saying to you, based on the amount of risk that all of your activities pose, and you need to know, you need to put dollar values to those risks. This is the percentage that you should be using. So I want to look at, I'm going to choose this one, the framework, and so I'm going to strongly suggest to you that this particular document, the Basel III framework, that you save it, all right? You go to the Basel website, the BIS website, and you save it, all right? So you look at the framework. That framework is going to tell you what Basel III is all about, all right? So they're strengthening the global capital framework. That's one thing, all right? How are they doing that? Raising the quality, the consistency, and the transparency of the capital base. In other words, banks now need to look at the quality of the capital that they're holding, all right? They need to be consistent with the quality of capital that they're holding. And in their financial statements, they should be saying how that capital is made up. All right, what it is made up of. They need to identify the risk. Okay, and so they now need to have a risk management framework. In identifying the risk, then they're going to determine the capital. And so, in Basel III, they are looking to raise the quality, consistency, and transparency of the capital base, all right? And so they tell you that tier 1 capital must be common shares and retained earnings. So your common shares means the shares, the money that your shareholders have invested, plus your retained earnings. And so every year, the bank should be taking some of its profits into retained earnings, right? And they have set of principles for that. They tell you exactly how to do it, all right? And across the globe, or in all banking systems, they're making it uniform. So they're requiring the same thing across the board, all right? They're enhancing risk coverage, all right? So the crisis, the 2008-2009 crisis told them they need to increase their risk coverage. So, what is it they did? So they raised the capital requirements for banks' trading books. In other words, the securities that banks are trading in, they raise the capital requirements for that, all right? And any other securitization exposure, so your mortgage-backed securities and so on, those are what crashed the market. They increase that, all right? They are requiring stress testing and a value at risk capital requirement, all right? So that's part of Basel III framework. They increase the requirements for what you call re-securitization, all right, in the banking book, so both your loans and your trading, all right? They increase the standards for Pillar 2, the Pillar 2 coming from Basel II, all right? So Pillar 2 is the supervisory review process, so they increase the standards for that. And then Pillar 3 is disclosure, so that's in your accounting. You need to disclose what you're doing in your financial statements, all right? And so they continue every year when the banks, when the central banks meet, they go over these, okay? The third thing they did in Basel III, supplement the risk-based capital requirement with a leverage ratio, all right? And they tell you how to calculate the leverage ratio. So all of that is there. They reduce the pro-cyclicality and promoting counter-cyclical buffers. Let me try and break that down. Okay, so when Basel II, all right, spoke to having stocks, all right, and what you do to protect the institution from its investments, investing in the stock market, investing in equities, mortgage-backed securities, and so on. And so what happened was that as the crisis occurred, the shocks from that crisis to the banks created even more fallout. And so when you're investing in the stock market, you tend to invest based on the business cycle, the economic cycle, all right? And so just about anybody investing uses what you refer to as a pro-cyclical type of investing, all right? But that pro-cyclicality means you're going with the cycle. That would have affected, that would have made the fallout even worse because everybody is doing the same thing, all right? And so they added upon, in order to change that pro-cyclicality behavior, they change the accounting standards. They ask you in your accounting standards, you have to mark to market. You have to include your mark to market assets, your held to maturity loans, your margin practices. Most of you would not have done anything in margin trading, but for those in 3053 where we talk about when you're investing in futures, you have to hold a margin, some money is in an account. Well, in investing in stocks, you have a margin account where you can borrow money from your broker. All right? And so they included all of those activities in the standard. All right? So that's what they talk about, reducing pro-cyclicality and promoting counter-cyclical buffers. So they are increasing the amount of capital to protect against that, okay, against that activity. Please, you need to read it through. It may seem a little heavy. Read it through. I can almost guarantee you, you're going to have a question on there about regulation. All right? Read it through. Understand what the regulatory arrangements are. Understand what Basel Accord is all about. The whole issue of capital adequacy. All right? So, if you go further down in that document, it speaks to the capital, the common equity tier 1, then you have additional tier 1, then you have tier 2 capital, all right? And they tell you what are the different criteria. I'm not asking you to know the criteria. I'm just asking you to understand what the criteria are about, why they're there. All right? So, common equity, which is tier 1 capital, must be at least 4.5% of risk-weighted assets at all times. All right, before it was just 8% of risk-weighted capital. Then it says tier 1 capital must be at least 6% of risk-weighted capital, risk-weighted assets at all times. All right? And then tier 1 and 2 must be at least 8% of risk-weighted assets. Remember, tier 1 has your common equity tier and you have your additional tier. So they made them much stronger. All right? What you're required to know is what the Basel Accord is, 1, 2, 3, how it has changed, how it affects the system, and how it is used. Okay? So that's actually all I want to say today on capital adequacy and on capital adequacy and off balance sheets activities and off balance sheet risk. Okay? Right, so I have some papers for some people. Those of you who don't come to tutorials, please don't even bother to expect me to have any mercy if you get 46 or 47 overall. I'm just telling you. If you need an extra 2 marks to get the 50 and you don't come to tutorial, you're not getting it.
Every time or most times?
You need to, I am sure that there are people in here who have not come to at least 3 tutorials. And I want to a quick run through. Where's Kiran? I thought I saw him earlier. Leisure,